From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Hello. Thanks for tuning in to another episode of the Macrocast. I'm your host, Ylan, a managing director at Penta. My co-hosts are John Fagan and Brendan Walsh of Markets Policy Partners. And we have got a packed show today because so far markets are loving this blowout jobs report and everyone's breathing a sigh of relief now that the debt limit disaster has been averted. And we have got a special guest today, Marc Goldwein, Senior Policy Director at the Committee for a Responsible Federal Budget. He's here to help us understand what's in the debt limit bill and its impact on the U.S. economy. Hey, everybody.
Good morning.
Good morning. So let's just kind of set the stage of where we're at, because both chambers of Congress have now passed what they're calling the Fiscal Responsibility Act. That, of course, is the bill that raises the debt limit until January 1, 2025. No default. Yay. The drama around the debt limit is now over. And that was really, obviously, the primary goal of this bill. But Marc, I'd love you to sort of walk us through what else is in it, because Republicans did get some pretty major concessions on government spending from Democrats in exchange for their support. So walk us through the fiscal side of this bill. What does it do?
Yeah, great question. So the core of the Fiscal Responsibility Act, besides the debt limit, is 2-year discretionary spending caps. Now, about a third of the budget Congress appropriates every year. Every year they decide how much will go for defense, how much will go for the Environmental Protection Agency, the Department of State, K-12 education, things like that. But for the last few years, they've been kind of deciding to spend as much as they want. There's not been any real constraints either through the budget process or in the law. What this would do is it would put a cap on how much they can spend in defense and non-defense, both next year for 2024 and the year after that for 2025. For defense, that cap basically is 3% growth year over year, which is a bit below inflation. It's about what the president requested, actually exactly what he requested. And then for non-defense, on paper, it's actually a pretty big cut. Depending on how you measure, it's 5 to 10%. But there's a number of side deals that would essentially put non-defense at a freeze, meaning we'll spend the same amount next year as we did this year, despite the fact there's actually pretty substantial inflation in the areas that are affected by non-defense. And then going forward, there's a second year caps that limits them at 1%. Beyond that, there's some softer targets. They're not enforceable caps, but they're caps based on various rules and procedures that continue to limit that growth to 1% through 2029. There's also a number of much smaller provisions that don't add to very much money, but I think are meaningful to those that supported them. For example, there's a reform to food stamp and welfare work requirements. And these reforms actually expand work requirements for some folks, like those that are in their early 50s, but they loosen work requirements for others, like veterans and those that are homeless. As another example, the bill rescinds a bit of what's left of COVID relief money that hasn't yet been spent. There's a small pots of money in a bunch of accounts, over 100 accounts or so, and it rescinds a lot of those. It also restores something called administrative pay-go, which means that when the administration has a regulation, it's supposed to find a way to pay for it if it's costly. It codifies the end of the student debt repayment pause. That pause has been in effect since spring of 2020. The administration says it's going to end August of this year, but they've actually said that many times before, then they've extended it. So this kind of forces their hand that they have to do what they're going to say. We could go down the list. There's a pipeline that's added, a tiny bit of permitting reform, just a down payment. But that covers the larger elements of the bill.
Top line, how much is this supposed to save over the next 2 years, over the next 10 years, whatever window you want to choose?
So the bill creates about $250 billion of direct savings, meaning the actual things that are written in the law would save about $250 billion. Most of that is over the next 2-3 years. But the way that we look at discretionary spending, because it's decided every year, is we need to make some predictions about what will happen going forward. And the truth is, the best predictor of appropriations in year 2 is what they were in year 1. And so when the Congressional Budget Office looks at this, they assume that whenever those caps end, we keep spending at that level plus inflation. That's a reasonable assumption, not perfect, but reasonable. Under that assumption, the Congressional Budget Office thinks in total, this bill will save about 1.5 trillion over a decade. That could be as high as 2.1 trillion if we abide by these soft targets that I mentioned that are not actually very restrictive, but they could choose to abide by. On the other hand, we've tried to do the math adding in these various side deals, which I'm sure we'll talk about later. And if you add in the side deals, that 1.5 trillion falls to 1 trillion. So that's a very long way of saying 1 to 2 trillion, depending on how you look at it.
So that sounds like a pretty big number over the course of a decade, especially when we're coming out of a period where government spending has reached unprecedented levels in order to respond to the COVID pandemic. John and Brendan, do you expect this new fiscal restraint to have any impact on economic activity?
Well, I think when we look at the landscape here, we'll talk a little bit about the confusing macro picture, and today's jobs data just added more mud to already muddy waters. But in general, looking at the student debt issue, that's one that you can point to as potentially something that is immediate. And could be a weight on consumption, on spending in a demographic that's very important, spends a lot on services and that sort of thing. We've seen strength in services, and so that's one place that is an area of focus potentially.
Yeah, and I think in terms of the macro, what we're cutting isn't all that big of a deal, but the student loan repayment is a big deal. That's I think they averaged at something like $333 a month for the average person to repay. So that's a big deal, especially if you haven't paid it in 3 years. You're going to have to, figure out how you're going to do it again. I don't think it's something that, is going to send us to recession, but we're already seeing the slowing of the consumer. Brian Moynihan, the CEO of Bank of America yesterday said that the Fed has achieved their goal. They've really slowed the U.S. consumer. And we've had a number of announcements, especially the dollar stores of the world and their competitors. That's the low end. That's where you go, the last place you go. When you're kind of running out of money, and they're seeing a huge headwinds to the consumer. So there are signs that the consumer is slowing, and this will probably only exacerbate that.
Yeah, I think that brings up a really good point, which is that we are now seeing both the Fed and fiscal policy rowing in the same direction.
Yeah.
And to what degree does Congress sort of embracing fiscal restraint impact the Fed's decision? Does the Fed need to tighten as much as it would have otherwise, since we have lawmakers already doing part of the job for them?
Yeah, I think the Federal Reserve here is going to be looking at this and putting it into the the mosaic that they're already looking at, this fragmented mosaic of the economy that they're already looking at. And on balance, as you say, Ylan, it is probably in potentially another reason for them to be cautious. We've seen the messaging this week emphasize the need for possibly a month of deliberation here in June, and rather than another hike, and to see how things play out. And so this, on the margin, may slow them down and give them something further to chew on later in the year, but probably only incrementally.
Well, one way I would think about this is, yes, now for the first time, discretionary monetary policy and discretionary fiscal policy are rowing in the same direction. But discretionary fiscal policy is rowing against a current that is actually expansionary, right? Because fiscal policy on its own is becoming more expansionary. Deficits have been rising basically since August because tax collections are down because of Social Security, cost of living adjustments, et cetera. So what this kind of does is moves fiscal policy from expansionary to neutral. And I think that's good, because I think that leaves the Fed solely in the driver's seat. I mean, I'd rather go further, but I think that means that sort of the Fed has more power here. And this may be the difference between one less rate hike. I mean, if you look at the savings here, the student debt pause, although I think it may be a bit less than meets the eye, because implementation is really important there. I think the administration can still say, we're going to give you, an extra 6 months before you have to repay. But when you look at this, I think you could see there's a quarter point of GDP of headwinds in this bill. And that might mean a quarter point less of rate hikes that's necessary.
Mark, I wanted to ask you about the legacy spending from the bipartisan infrastructure bill and the IRA. Obviously, one of the things, and we'll talk a little bit about this in the non-farm payroll context, but construction is really strong, and that's part of the story. And so, how do you, when you look at the fiscal picture, we have this idea of a fiscal impulse hits the economy and boom, there's an immediately stimulative effect, but that really applied more to sort of the COVID relief, immediate, straight into the veins kind of stimulus rather than this drip, and slow, long arcs of infrastructure spending. How do you think about the impact of these, and how do you model out the volumes of spending that are going to be coming through and continuing to be coming through under those bills?
This is a great question, because one thing that's happening with deficits is, they spiked and then they came way down and now they're rising slowly. And so if you look at it as the total, you see one picture. But another thing that's happened is the composition has really changed dramatically. It's a lot less, we're sending cash to people, and it's a lot more we're doing stuff. And I think that's going to be even more so the case going forward as the infrastructure bill starts to spend out, because then that spend out is really low. There's sort of good news, bad news there. The good news is when you do stuff, it's less inflationary pressure than when you send cash, because you're creating new demand, but also new supply, right? And so you're in some ways absorbing your own demand, and that's good. The bad news is the Fed has an awful lot less control over this. This is sort of a pre-baked sector of the economy. And so it even narrows further where our inflation fighting can go. The other bad news is, even though I think inflation is mainly a macroeconomic phenomenon, all the microeconomic phenomenon are sort of at their worst when it's government programs, because they have all of these permitting rules and regulations and various sort of non-macroeconomic desires that tend to drive up costs. That's why I think permitting reform is so important. We only did a tiny bit of this in this bill, but when government pays more for things than the private sector does. And so that's another way we're probably pushing up prices at the micro level.
On the political side, I mean, this is being characterized as, both sides are obviously claiming victory, right? But I think that if, in general, this is a sense that this is a bigger win for the White House than a lot of observers had expected. Ylan, I want to get your take on this. And, what are you hearing? What are you sensing? Where are you come down on this issue of, it's Washington, D.C., right? You got to have a winner and a loser, right? In the zero-sum political world that we live in. What do you think about the assessments of how this landed?
Yeah, I don't know that there is a winner and a loser, because I think everyone's going to say that they're the winner. Everyone's going to claim victory in this bill. But, I think if you look at the substance of the bill, it is hard to say that Democrats did anything beyond avert disaster, right? That all of the side deals and all the pieces that Mark was talking about were things that Republicans put on the table, and then Democrats tried to whittle away at a little bit. And, the benefit that they got and the win that they got, which Biden will speak about to the country later on tonight, is, the economy will keep chugging along. America will pay its bills. You won't have an unprecedented default. But that's just what it should be, right? That's just what the baseline should be. That shouldn't be declared a victory. And so I think that Republicans really were able to push Democrats and were able to hold the line in a way that I think surprised the White House and surprised Chuck Schumer in order to force them to the negotiating table and not some of those victories. So, I really think that Republicans came out of this with the upper hand.
I think it kind of depends on your starting point, right? So relative to February, I think, Ylan's assessment is exactly right. But relative to a month ago, it's sort of a bit different, because this has all been about the expectations game. And so I think the White House did a great job lowering expectations so much that where they landed was, they could reasonably argue, this is probably pretty close to where we'd have landed anyway, had we done this through other channels. And maybe we got a little bit of extra that we wouldn't have. And that's the argument they're making.
I wonder if one of the big wins will end up being that we don't have a government shutdown in September, right? That this was sort of the last big fiscal fight, and that everything else from now through January 2025, at least on the fiscal side, is, as you were saying, kind of baked in. I mean, there seems to be no reason to have a fight over appropriations in September when we basically already done that, so that, you know, the fall will be relatively calm. Maybe I'm wrong. Congress doesn't always need a reason to fight over something. They can just do it anyway. But it seems to me that they kind of killed two birds with one stone here.
And putting it out, kicking it until after the election is, you know, I think for all of us, that's a relief, you know, to have another debt ceiling fight in the midst of what will be a knockdown, drag out campaign, both at the presidential and congressional levels and state levels, let's face it, all across the country next year. You know, that's just that would be gasoline on the fire. And so that seemed to be, and putting it in the lame duck session, that seems to be a relatively responsible and bipartisan compromise there. Just a last question. Does, you know, obviously the Freedom Caucus in the House is not happy. There's, you know, the resentment over how Speaker McCarthy handled it and so forth. Is this just posturing, or do you think that they really seriously make a run at taking him down because of the outcome of this bill?
I wouldn't try to conjecture. I'm sure some people are very mad. But look, I think Speaker McCarthy has been extremely transparent from the front that he wanted to pass the Limit Save Grow Act in order to force the White House to negotiate. He said that about 50 million times. So anybody that thought that he wasn't going to then go negotiate with the president, or that he was going to be such a good negotiator that he was going to get the Limit Save Grow Act plus naming a post office, they weren't kind of being serious with their expectations. This was always going to be a compromise. Could he have done a bit better? Could he have done a bit worse? I'm sure. But you know, the idea that people should be surprised he was negotiating with the White House when he said it, you know, more times than I can possibly count is a little bit silly.
Well, I think also if you just look at the vote totals in the House and the strong majority of Republicans that voted to pass this bill, I think that even if there was a motion to vacate, it wouldn't go very far. So I think that the number of Republicans who stood with McCarthy on this bill seems to me to lower the chances that there might be a rogue member or two, and I think we can all think of who they might be, who would want to go down that route because they know it would ultimately be unsuccessful. There's one more thing I wanted to bring up around this debt limit fight, which is that, you know, now that, well, once the president signs the bill and the debt limit is actually raised, Treasury will have to refill its cash coffers. And that could have some interesting repercussions or interesting consequences for the financial system and for bank lending in particular. John and Brendan, can you walk us through what the mechanics of that might look like and why it might factor into the way that financial conditions might move in the future?
Yeah, so Treasury is the general account at the Treasury has been basically the coffers are not the Scrooge McDuck levels filled with gold at this point. They are. I
love a DuckTales reference.
They're rock bottom. So in this case, the Treasury is going to build those up again, and that gets into a situation where you have the essentially they're issuing debt. They're still, deficit spending is still going on, but some of that issuance is going to be, used to refill the coffers of the Treasury Department. Net, that is going to burn down the reserves at banks, because the financial system are going to be the main buyers of the treasuries that that are issued and the proceeds of which go in to fill up these coffers. And with less reserves at the bank, that's going to tend to, on the margin, mean less bank lending. Brendan can elaborate and correct any
no, that's totally right. Because they have to hold reserves against it if you're the bank. So you're just going to do it for the treasury because you'll get a better yield. So we were already seeing bank lending slow down because of the regional bank crisis. And now we're also seeing the consumer slowing down. So the banks are pulling back on that front. So this is only going to exacerbate that issue. Another reason why, the Fed probably, it makes sense for the Fed to pause here at the next meeting to kind of reassess where the economy is and where it's going.
So I want to pivot a little bit, but Marc, please stay with us and talk about the jobs number that came out this morning. Maybe that's a reason for the Fed to have a dovish hike, perhaps, at its next meeting, because the jobs number beat expectations by kind of a lot. The Labor Department reported that the economy added 339,000 jobs in May. That's above the 190,000 that had been forecast. Now, the unemployment rate did increase to 3.7%, but it looks like the size of the labor force also increased. Hiring was pretty broad-based. Brendan, what do you make of the numbers?
So it's kind of a tale of two cities. Yes. The establishment data, which comes from companies, they send in. Okay, we hired 2,000 people. That was very strong, though it was a little mixed in terms of who added jobs. The industries that did really well during the pandemic, they're not really hiring anymore. They were basically flat. But the industries that had a really hard time hiring during the pandemic, that's where all the jobs came from. So that's a good sign. But it also is a sign that parts of the economy are not expanding. They're holding on to their workers, not laying massive people off, but they don't see the need to add. So as the industries that are kind of like we talked about, refilling their coffers, refilling their labor force, once they're there, they're probably going to slow too. But the household survey, which is a survey of people, whether you're employed or not, and how much you're making. That was kind of weak. So the civilian labor force increased by 130,000, which is a very good sign. But the unemployment rate went up. So the number of unemployed increased by 440,000. Another employed decreased by 310,000. So the people that came into the labor force haven't found jobs yet. And a number of people actually were laid off. So now the unemployment rate is up to 3.7% from 3.4, which is a pretty big jump. And also the wages, they're still fine. We're up 4.4%, but 4.3%, but it's slowing. We used to be up in the sixes. So that's kind of a sign going forward that the labor force isn't quite as strong as that 330,000 job number said, and. We don't really have an explanation for this, but the black unemployment rate went from 4.7 to 5.6, which is a massive jump. It's still at historical low levels, 5.6, but that's a little troubling.
John, does that change the Fed's calculus at all? The large jobs number?
Yeah, well, the Fed's communications over the past weeks really have changed the minds of market participants quite a lot about the June and July meeting. And so essentially you had the June meeting odds creeping up. You saw lots of talk at the Amelia Island event, which you attended, Ylan, and there was a sense that the Fed was ready, to potentially do more. And the implied odds in the futures markets for another 25 basis point rate hike at the June meeting crept up above 50%, close to 60%. But then some of the crosstalk and some of the other communications began to shift in the other direction in recent weeks. And it sort of culminated in the Wall Street Journal, which is a very well-sourced Fed communications channel, some would say. Came out on in the middle of this week, basically, or earlier this week, with a story that the Fed was basically preparing to pause, except if there was some sort of blockbuster, non-farm payroll report. Well, is this a blockbuster payroll report? As Brendan pointed out, you've got, the two-handed economist problem again. You got on the one hand, and on the other, you have some underlying weakness. And so essentially, if you're a Fed that is looking and prone to pause at the June meeting, you can certainly find justification within that. The unemployment rate, the other details and the cooling earnings. You don't have, this is not going to force your hand. It's not so hot across the board. But, still the headline number, if you're looking for an excuse to throw in a June hike, the headline number can give you that. So the markets are reflecting that ambiguity. And, we've gotten at least now the odds ticking up of a June hike, but not at least so far going up above sort of the 50% range. The base case remains a hawkish pause, the pause that refreshes at the June meeting, and then potentially another hike in July. But then beyond that, it is game over for the tightening cycle according to the futures markets. With rate cuts, we still talk about, how we, aren't really sure what the futures markets are thinking when they're pricing in rate cuts potentially as soon as November, and certainly, more greater odds as when you get out into December. We don't see that, but the markets do, and that's kind of where we are.
Marc, the jobs report showed that government hiring was at about 56,000 jobs added to government employees in the month of May. A lot of that came from local government hiring. Do you expect that to change now that the Fiscal Responsibility Act will become law? Or do you think that government will still contribute to new jobs each month?
Well, I think what we've seen for the most part is that state and local jobs have lagged just about every other sector of the economy in this recovery, which is strange because it's despite the fact that for a while, state and local government revenue was well above about just about any other sector of this economy. I mean, states have been really very flush with cash, both as a result of like $900 billion of federal aid and their own revenue. I expect that the Fiscal Responsibility Act is going to affect on the margins. The bigger question is, will states continue to produce those jobs as their revenue is falling? And it's falling in part because we all had, a great 2022. That's done, right? The big capital gains are done. Inflation adjustments have caught up, et cetera. It's also lagging because a bunch of states saw huge surpluses and chose to cut taxes. And so to me, the big question, Fiscal Responsibility Act might mean states get a little bit less federal aid or federal support, I should say, than they otherwise would have out of the appropriations process. But that's going to be marginal. The big question is, how are states reacting to their declining revenue, especially because they still actually mostly have pretty huge rainy day funds.
Yeah, and I think to Marc's point, that the fact that the local governments are able to hire, I think, is a sign of slowing economy. I think they had money, last year also, but I think people just didn't want to do those jobs. So now they're able to hire because it's harder to find some of the fun jobs, or you weren't working and now you have to find a job.
Well, we could keep talking about this all day and into next week even. This was certainly a big week in terms of fiscal news, macroeconomic news, but we have to leave it there. Thank you to everyone for listening to the Macrocast. I'm Ylan Mui with Penta. My co-hosts again are Brendan and John from Markets Policy Partners. And a big thank you to Marc Goldwein of the Committee for a Responsible Federal Budget. You can follow them on Twitter at BudgetHawks. And please remember to like and subscribe to the Macrocast wherever you get your podcasts. Have a great day, everybody.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.